Welcome back to the deep dive. Today, well, we're wading into something quite serious, looking at the Maldives and the really high debt risk they're facing. We're going to unpack a proposal aimed at, turning a massive liability into a potential asset.
It really is a critical time for them, yeah. The analysis we've reviewed confirms the Maldives is placed at high risk of debt distress. I mean, public debt is projected at, 133.5% of GDP for 2024. That's significant.
133.5%. Wow. That doesn't leave much room to maneuver, does it?
Not much at all. And a large part of that debt load, it's tied to what the sources call a sizable infrastructure spending push.
Right, infrastructure. And our deep dive today focuses on a specific piece of that, around $472 million in sovereign loans. These are linked to two big connectivity projects, the Cinnamal's Bridge and the newer Thilamal Bridge, or GMCP.
Exactly. And to understand the proposed solution, you kind of need the details on that debt. So the Cinnamal's Bridge, that included a $72 million concessional loan from China Exim Bank. But the bigger piece is the Thilamal Bridge, the GMCP. That's backed by a $400 million line of credit from Exim Bank of India.
Okay, $400 million. Even if the interest rate is low, like the 1.75% mentioned, that's still a huge principal amount.
It is. And here's the fundamental problem, right? These bridges, they're vital public infrastructure, absolutely.
Yeah.
They connect islands, help with congestion.
Sure, essential stuff.
But financially speaking, they're what you'd call capital sinks. They don't directly generate the hard foreign currency, the U.S. dollars, the FX needed to actually pay back those specific foreign loans.
Okay, so that's the mismatch. You borrow in dollars, you need dollars to pay it back, but the bridge itself doesn't earn dollars. That creates the liquidity risk.
Precisely. External liquidity risk. So the proposal we're looking at is pretty radical. Instead of just accepting that $472 million as a sunk cost for infrastructure, it suggests using that same amount, $472 million, as seed capital, but shifting it entirely, developing high-yield, state-owned luxury tourism assets, leveraging the nation's main FX engine, tourism.
Okay, hold on. So take the money notionally meant for bridges and build resorts instead. How does that work out financially?
Well, the analysis quantifies it. They use an industry benchmark, about $1.2 million in capital expenditure per luxury resort key. With $472 million, you could fund roughly 393 high-end resort keys.
393 keys. That's like, 4 or 5 new luxury resorts?
Pretty much. 4 or 5 state-owned high-end resorts. Think about it, maybe half a kilometer of overwater villas, all designed to pull in hard currency.
Okay, I can see the logic in leveraging tourism, but what's the payoff? Can it really generate enough?
That's the interesting part. Luxury resorts, they have very high gross operating profit, GOT, per key. The model uses a conservative estimate, $175,000 per key annually. So that portfolio of about 393 keys is projected to generate around $68.78 million in annual FX GOP.
Almost $69 million a year in hard currency.
In hard currency, yes, from those state-owned assets.
But let's circle back to the debt. That $400 million Indian line of credit for the Thilamal Bridge, that must have hefty annual payments, right? The analysis estimates it around $23.6 million per year. Can $68 million in GOP really cover that comfortably?
Comfortably. It covers it almost 3 times over. That $68.78 million GOP against $23.6 million debt service gives you a debt service coverage ratio, a DSCR, of 2.91.
2.91x. Wow. Okay, so for every dollar needed for debt repayment, these resorts would be generating nearly $3 in operating profit.
Exactly. That's an incredibly robust safety margin. It acts as a massive buffer against, future economic shocks or tourism downturns.
So this isn't just finding a way to pay the bill. It sounds more like a structural shift. But making it work requires more than just building resorts, presumably.
Absolutely. The crucial step is institutional reform. Specifically, reforming the Sovereign Development Fund, the SDF, that's the nation's sort of savings fund, meant to collect foreign currency reserves.
Okay, what needs changing?
The proposal argues the law needs amending. It needs to mandate that 100% of the net profit from this new state-owned tourism asset corporation.
The entity running these resorts.
Yes, 100% of its net profit gets channeled directly into the SDF. And this is key. It has to be transferred in foreign currency, in U.S. dollars.
I see. So you lock in the FX benefit. You're essentially reversing the usual flow instead of borrowing externally for a public good.
The FX-generating sovereign asset directly funds the public good, or at least covers its financing cost with a huge surplus.
Yeah.
It decouples development from that risky external debt cycle.
It guarantees a domestic source of hard currency to cover those foreign currency liabilities. That's a powerful pivot.
It really is. It moves beyond just managing this specific debt. It's about building long-term fiscal resilience.
So, summarizing this, it's a strategy to use the country's core strength luxury tourism to directly counteract the financial risks of essential infrastructure development.
Precisely.
Yeah.
And it raises a pretty provocative final thought, doesn't it? If these kinds of sovereign assets can generate enough guaranteed hard currency to cover major infrastructure costs almost 3 times over,
Yeah.
how quickly could fully adopting this model free up the nation's fiscal space? Think about immediate critical needs like, say, urgent climate adaptation investments, which the Maldives desperately needs. Could this be the key to unlocking that kind of resilience much faster than relying on traditional finance? Something to consider.